Hi, and welcome back again to Tim Bigham's Options and Volatility Newsletter. We'll be taking a look today at some vol capture trades, several of them on Rocket Lab's RKLB, where some big time unusual option activity spikes implied volatility to an extreme, to say the least. So, several ways to play it. So, let's jump in and take a look. First, here's the chart on Rocket Labs. You can see on Friday the stock did break out to new recent highs and basically to new yearly highs, did pull back to close well off the highs above 7 on the day, closed at around 6.5. The technical is getting overbought again, right? Bollinger percent B well over 100, 9-period RSI, looking towards 90 on that, right? MACD also at an extreme, but most importantly, implied volatility off the charts, to say the least. So we'll see in a second how huge option volume drove IV to extremes that favors absolutely selling options to benefit from the expected reversion. So taking a look, here is that massive spike in IV. Took a look first at the calls here, took a look at them across the term structure of vol spectrum, right? 60, 90, and 120. You can see all the options lifted in kind, the whole vol surface. But basically, this is a 2-year chart, pretty much painted at 65-ish, give or take, over the past several years. Then on Friday, saw this just enormous spike in implied volatility, right? And they did have earnings come out already, right? When we took a look at that chart, here are earnings, right? So earnings have already come out on Rocket Lab, so certainly not a earnings kind of play based at all. More of a mini me mania, right? The stock has become a favorite of all the meme websites out there. So certainly taking off to the upside. We'll see how long it lasts. Usually it doesn't, but certainly the jump in implied volatility extreme, to say the least. Also pulled off puts and calls both here, right? Going back again 2 years and looking at out of the money calls and puts, a 30 delta call, 30 delta put, 90-day IV, but whatever expiration you look at will be very similar. But as you can see, pretty much painted here again around that 65 level before Friday, where we'll take a look in a second at the huge volume drove implied volatility off the charts as everyone came rushing in, not caring what they paid for options, looking to pay anything, right, to play that potential big time breakout in Rocket Lab. So it certainly spiked things off the charts. Took it on a shorter term basis, 3-month chart of IV, right? And again, went calls and puts across the term structure of vol, right? From looking at a 30, 90, and 120-day IV. You can see pretty much again painted right at that 65 IV, give or take a few wiggles. And Friday, everything lifted up off the deck here in a massive way, basically doubling the IV in a day, which means option prices became extraordinarily expensive, which absolutely favors selling option premium. What caused that? As we said, that huge option volume coming in. Here's Friday's option volume. You can see almost 270,000 calls traded, right? And over 35,000 puts. The sizzle index, which measures kind of how hot the options are, off the charts, right, at over 3. Rarely see that number of that kind at all here. IV percentile, we saw in the previous price chart at the highest level we've seen in a big way, right, at 100%, which means option prices haven't been this expensive and really anywhere even close to this expensive over the past year. So sets up a couple potential trade ideas to capture that implied volatility pop, right, and in effect selling very expensive options and then hedging with stock or puts. So let's jump in and take a look at a couple ideas I think make a lot of sense. So went back to July 15th, about a month ago, right, pulled off the option montage from then. You can see the stock closed at 572 back then, right? The January 6th call, and I just used the slightly out of the money January 6th at the time and went out to January. Certainly any expiration or strike would have a similar effect, right? Selling the January 6th call to help kind of hedge the cost of buying the stock, give up some of the upside, but certainly leave plenty of room for a nice profitable trade. IV at the time, as we said, that mid 60 level where it kind of been painted at. The buy right, buying the stock at 572. selling that call at a little under $1, right, would have cost $4.75. Potential gain if the stock closes above the $6 short strike price January expiration would have been $1.25. So a very nice gain of $1.25 on a $4.75 investment. Let's fast forward to Friday. You can see the stock over the past month since July 15th has gained nicely, like closed at 84 cents higher, or almost a 15% gain. That January 6th call, though, closed at just under $2, a gain of $1, right, from July 15th that we just saw earlier when it closed just below $1, right? But it gained 16 cents in that time frame, more than the stock did. So the at-the-money January 6th call actually gained more than the stock, which makes no intuitive sense. Why? All that call buying, the IV exploded from 65 to well over 100. That made the buy right, the covered call trade right, buying the stock, selling that January 6th call, actually get cheaper with the stock ripping higher, right, by 15%. It got cheaper by 15 cents, right? A very nice drop on this low price of a stock, even with the stock gaining 84 cents and a month worth of time decay bleeding out, right? So this set up ideally for a covered call trade if you want to lean a little bullishly with the call buyer out there, right? But really take advantage of the fact they are willing to overpay dramatically for these options. A couple other ways to play it. The October 6-10 sell strangle, right? Selling an October 6 put, selling an October 10 call at the same time, right? Selling a bullish put, selling a bearish call. You're kind of looking at a neutral sort of scenario, right? But you're selling both options to take advantage of the premium they are willing to pay for these options based on that kind of meme mania and huge option volume out there. So again, went back to July 15th, about a month ago. The stock, again, closed at 572. That October 6 put, which was in the money, right? The 6 put, stock was below 6, so it was an in-the-money put, closed at 85 cents. The 10 call, well out of the money, right? Over 4 points out of the money on a $6 stock, right? Closed at a nominal value just under a dime. Implied volatility, right? On these, we're trading, again, right around that 65 level, give or take. So that October 6-10 sell strangle, selling the $6 put, $10 call, you could have received a little over 90 cents for that, and it would have set you up long 40 deltas, right? You're selling a 49 delta on that in-the-money put at the time, right? And selling only a 9 delta, right, on the call. It's so far out of the money. Puts obviously have a negative delta, so you'd end up 40 deltas net long. A bullish trade comparable to 40 shares of stock for each time that you do this. Let's fast forward to Friday and see what things change, right? The stock, as we said, gained 84 cents in essence over the past month from July 15th to August 16th, right? Or about 15%. That October 6 put that we were looking to sell on July 15th with the stock lower actually gained 10 cents, right? So the stock went up in price and the October 6 put went up in price, which makes no sense except that implied volatility jumped through the roof, right? And a month's time passed as well. That should have a negative effect on the put. The October 10 call, right, went higher by 60 cents. Remember, it was trading under a dime back on July 15th. Now it closed at just over 60 cents, right? Why? Because that huge jump in implied volatility, people paying anything for those options. So those options, the calls, the October 10 call, gained 60 cents with the stock up 84 cents. They're still well out of the money. Stock is at 6.5, let's call it, right? It's still 3.5 points out of the money, which percentage-wise, you're looking at, you know, about 40% out of the money plus, right? But these options moved basically like they had a 67 delta, right? They're up 60 cents with the stock up 84 cents. So these extreme as well. You can see here's that jump in IV that was previously right around that 65 level. The IV now has basically more than doubled on average there, right? And that October 6-10 sell strangle now can be had selling for $1.60 plus. So before it was trading under a buck, remember, when we looked at it the previous time at about 92 cents. Now you're looking at it at over $1.60, even though the stock is now in between the short put and the short call. This is exactly where you want the trade to kind of be, right? Is in between the two short strike prices. That should make the trade cheaper. Plus, you have a month's worth of time premium bleeding out, right? But because of that huge jump in IV, the trade became much more expensive, right? By a great amount on the trade. So you're able to pick up a dime more on the puts, 60 cents more on the calls, 70 cents more on that sell strangle, which previously was trading just under $1, now trading over $1.60. And if you put it on currently, you're about as flat as can be, right? You'd be selling a negative 33 on the puts, right? The $6 put, selling a 34 on the call. You'd be net short 1 delta. That's about as neutral as it can be. So this is a way for someone looking to really capture just some, vol to kind of position as neutral as possible and look for the IV to revert. Then finally, we'll take a look at another trade. And of course, you can use any expiration, any strike prices out there. We saw that lift across the whole term structure of vol surface, right? Everything just ripped higher. But the October 7 sell straddle, right, which is selling both the call and the put, right? Took a look at that as well. So went back again to July 15th stock, 572, right, as we saw before. That October 7 put, which was in the money by a decent amount, right? Trading at $1.55, right? The $7 put and the stock's at 572. It's worth $1.28, so carrying about 23 cents or so, a quarter of time premium somewhere in there. That October 7 call, right? Trading at fairly nominal value at about 32.5 cents, right? The IV on these options, both at that mid 60 level as we saw. So that straddle could be had for $1.87. Would have put you net long 36 deltas, right? Selling a 68 delta on the put, a 32 delta on the call. That makes sense, right? Because the put is in the money, right, by a decent amount. The call is out of the money by a fair amount, so you'd be a bullish trade. So you'd expect then, fast forwarding to Friday with the stock moving higher, right, selling that straddle should have been a profitable trade, right? You would have sold it previously at $1.87. You'd expect to buy it back cheaper, but no. Because of that huge call and put buying and the huge jump in implied volatility, you see that those October 7 puts, right, increased 10 cents even with the stock higher and a month passing, right? They closed at a 1.625, right? The October 7 calls, right, gained 60 cents with the stock up 84 cents. They're still out of the money, right? But they ripped higher as well. You also saw a huge jump in implied volatility, right? We saw before trading at that mid 60 level. Now IV basically double that at virtually 130. So that October 7 straddle closed at 282.50, right? Gained almost $1, right? Even with the stock closer to 7. That's where you want it. If you sell a straddle, that's where you want the stock to close, is right at 7, right? It got closer to 7, should get cheaper, should be profitable, and a month time premium bled off, right? Should be cheaper, but it got more expensive. Why? Because of that huge jump in implied volatility. So by doing it now, you'd be net short 11 deltas, right? Selling a negative 44 on the $7 put and a 55 on the $7 call. Still not certainly egregiously short, but this is one if you want to be a little more aggressive with capturing some premium and a little riskier because you are a little bit shorter, right? And this is a, meme mania stock. We know how it ends, right? But along the way, you want to make sure you position size accordingly. So hopefully provide some insight into how we go about identifying trades with big potential edge here and how we look to go about structuring the trades and make sure always your position size is appropriate. So until next time, as always, here's the good trading. Take care.